Well, welcome everyone. I'm really excited to be here with Adam Parker, the founder of Trivariate Research. One of my first introductions to Adam Parker was when I got a new office at Maverick back in the day, and I was still getting the voicemails from the prior investment professional that was still in that office. And most of them were boring, just instant delete. And then I get this is Adam Parker from Morgan Stanley. And it was just like always entertaining and insightful. I'm like, I think I'm going to keep listening to those voicemails. Fast forward 10 years, I've been an avid, reader and fan really of Adam's work in the world of strategists, where there's probably a little bit too much consensus hugging. I've always found Adam's really thoughtful and independent minded approach to be super insightful. As it relates specifically to the factors and risk management program, risk model program, Adam has really been a leader and at the forefront of integrating quantitative approaches with fundamental approaches. So maybe we'll ask him if he can figure out a better name than quantamental at some point. But Adam has really been a thought leader in the quantamental space for many, many years now. So thank you so much for being with him, Adam. If there's any kind of additional color you could give about, your background, what you're doing at Trivariate, and really kind of how you got to where you're at now.
Thanks for that introduction. That's very kind. You didn't tell me that story about the voicemails. There's a funny story on that. When I first got to Morgan Stanley, they sort of let you choose, like, who do you think should be on your distribution list? So I say everybody. Everybody should care about strategy. So they must have had like 10,000 people's voice numbers on that thing. So the first day, I guess I gaslighted the person in charge, and they sent my voicemail out to all 10,000 numbers. And I'd say like 300 people in Europe, cell phones went off in the middle of the night and woke them up. So it became an infamous and a negative that I had to Adam Parker, Morgan Stanley. So you're the first person who said something positive about it. I appreciate that intro. Yeah, I guess Trivariate, what we do is we sell research, bespoke services, and analysis to people who care about U.S. equities. That ranges from asset managers, long-only hedge funds, to allocators, family offices, some private equity and crossover funds. We also have a lot of clients that are corporations, law firms, boards and management teams of companies, and then the larger RIAs that have institutions where they have kind of a strategic thinking at the top. So yeah, our work is targeted to people who care about U.S. equities.
In your materials, Trivariate talks about really looking at stocks and markets with three lenses: fundamental, quantitative, and practical. Could we start there and just kind of walk through the approach and dig a bit deeper into those three concepts and how you think about blending those concepts?
Yeah, I mean, and you could end up telling me that I'm just bad at marketing, but the idea behind Trivariate, or the three variables, was that it's a way that I think is helpful for people to analyze equities, and it's also was a bit of my own background. So I have a PhD in statistics, so back then that was somewhat novel, and it was a little bit more than 25 years ago, and so it wasn't as popular as it is now. And I kind of always came at the world a little bit more analytically than anecdotally, and so I started off looking at factors and signals and all that kind of stuff in my career. And then I became a fundamental semiconductor analyst. So, I covered the US large cap chip makers. So I had like a pretty formative experience tearing apart the P&Ls of companies and talking to management teams and all that. And then I shifted to being the US equity strategist at Morgan Stanley, which again, you heard the launch voicemail and several others, which is a little bit more macro, right? Ingesting all these signals, whether they were, rates or economic or currency, et cetera. And so I sort of felt like my background was some quant, some fundamental, some macro. And so those are the three variables that I've tried to sort of attach myself to as I think about giving investment advice to people who care about U.S. equities. And I guess quantitatively, Rook, like every day for every U.S. equity, I measure the company specific risk. We have our own proprietary way of doing it, but there's lots of pharma French, there's lots of ways people do it. And so what I would tell people, it doesn't happen as much, Brett, recently, but it used to be all the time. People say, well, I'm a bottom stock picker, I don't do any of that stuff. And what I would say back to them is totally get it, right? I mean, the average stock, I can explain about 40 to 50% of their average stock's returns from a few macro factors. So You should focus on the 50 or 60% that is available, and I'll try to help you with the other 40 or 50 that isn't. But said in English, I guess, if the market's up and growth beats value and large beats small, I'll make you a bet I know what Microsoft did that day. And I'll probably be right 90% plus days, right? So I think it's helpful to think about all parts of the stock, not just the bottom of stock picking fundamental part, but also, what's driving the rest of the returns. So we measure that every day for every stock and see if it's increasing and decreasing and what's explaining the returns, to try to help people sort of mentally avoid saying, I don't do any of that, because what they're really saying is I don't do 40 or 50% of what matters for most stocks. And I don't think that's a great answer anymore.
And Adam, how do you build out that systematic framework? Like, how is it similar or different from some of the other factor models that are out there? How do you approach that? And then, in what way does that like blend with the other pieces of the equity markets that you look at?
Yeah, I mean, I don't want this to sound like there's only one way to do it. There's lots of ways to do it. Well, we spent about 9 months building a database, and so there you need to spend a decent amount of money buying data. It can be everything from, the common stuff you think of: balance sheet, income statement, cash flow, valuation, to sentiment, accounting, ownership, et cetera. So we're downloading pretty close to 1,000 pieces of information every day for every stock, computing many pieces, a couple hundred or more, Z-scores, trends, crowding, company-specific risk, replicability, all these things. And then we back it up every day, 25 plus years. So what we try to do is we have a giant nightly production, and we use that to empirically study something. So if you say something as simple as China did a stimulus, what happens then? We can study the 11 prior stimuli, what happened, which sector, which style, which cohort, how much returns were explained. So a lot of the initial answer to your question, Richard, is going to be about the database and the production that we have. What we solve for some firms is just they don't want to spend a few $100,000 a year on data, spend the 9 months building the database, hire a couple Python programmers and somebody who's a data manager, because it's a pretty big lift, financially and time-wise. So instead, they can kind of outsource some of that to us, and we can help them do some of it. Getting a little more specifically focused on your question, because you kind of asked a two-parter in my twisted lens. One was kind of the mechanics, the data, the production. The second was specific to the company-specific risk concept. We have a 7-factor model. What that is the equity market beta. We use the median of 4 horizons. We can get nerdier on that if you want. 2 size factors. So do mega large stocks beat mid, and did mid meet small micro? We actually found that size has a couple of different layers to it. It's not just big versus small. So that's 3 things so far: beta, mega large versus mid, mid versus small micro, growth versus value. So the growth stocks beat value today. Quality versus junk. So the some regimes were like, the government does a big stimuli, March 09 to June 09, March 20 to June 20. And then all you had to know was it a junk stock or not, and you knew it went up a lot, right? So we do that quality junk as a factor. And then lastly, liquidity and momentum. So those are our 7 factors: beta, 2 size, style, substance, liquidity, momentum. And then what's left over, we call company-specific risks. So it's kind of like 1 minus that. That's our own 7-factor model. The most famous is Fama French. There's 3 factors. There's different ways to do it, but we think ours kind of encompasses enough of what happens most of the time that we can track it. I wouldn't marry myself to say, oh, you think Microsoft's 38% of you, and I think it's 80. It's more about, using a similar approach for every security and then tracking it over time.
Makes sense. And it sounds like a lot of what you do is to take that database and take that factor model and then really analyze, event study, as you kind of mentioned, look back through cycles. What's that process look like? Is it driven by clients? Is it driven by sort of, hey, let's come up with sort of what's happening in the world today and then find analogies historically? How does that work?
Yeah, again, you ask good questions where my mind can go in 2 or 3 different directions. So one, I'd say I could start the most grandiose and say, okay, I want to give a new CIO a guide to resource allocation. That CIO hires really smart people who are alpha generating widgets, right? So I got Brett. Brett's a new analyst. He's an alpha generating widget. I want to put him in areas of the market where he can craft his trade to maximize his skill, right? If that were the logic and I was starting a new thing afresh, I might say, all right, there's 7 or 8 things I want to look at, and I'll describe them in a second. So that's one answer. That's one direction I could take your question. The other direction could be, where can a fundamental guy what kinds of stocks should they spend their time on? And is it worth having a differentiated view versus the index weight? So if you give me a minute, I'll riff down both sides of that question, but course correct me if you don't like where I'm headed. Okay. So one of the things we track every month, and we do it every day, but we publish every month, is there actually are 8 signals. One is the company-specific risk and the change in the company-specific risk. So biotech always has high company-specific risk, and generally banks are low. So I have the level, but then I also have the change. Maybe banks are getting a little bit more idiosyncratic, or maybe biotech's getting a little less because rates are rising like they were a few years ago, and it was explaining more of the returns as the multiples compress. So 2 of the 8 things I look at are level and change of company-specific risk, as I just described it. 2 more are the level and change of pairwise correlation. So I like to see, are all the stocks trading alike, or are some going up and some going down, and that correlation is rising? Banks generally trade a lot alike, but maybe it's getting a little bit more disparate because large banks are doing better than small, or whatever. So I track level and change of pairwise correlation. The third cluster, or variables 5 and 6, are going to be valuation dispersion. Are all the stocks trading at 20 times earnings, or are some at 40 and some at 10? And is that change in dispersion or level of dispersion telling me that something's happening where a fundamental mind should go in there and pay attention? And then the seventh thing I look at is I call opportunity set. How many stocks have beaten or lagged the index by 20% or more in each industry over time? Is that growing or not? Because that sort of tells me that things are happening underneath, and maybe there's a lot that are deviating. And then the last thing, and I'll repeat them again, is replicability, which is our metric for how many stocks are trading 0.7 or higher correlated over the last year. So what I try to do is say, what's happening to the level and change of company-specific risk? What's happening to the level and change of pairwise correlation? What's happening to the level and change of valuation dispersion? Are there a lot of stocks beating or lagging or not? And can I replace those with other securities or not? I like to know those things for every industry in the market. Then I can go to the CIO and say, look, here's the way I look at these 8 things. Here's the industries that look like I really need a fundamental person paying attention. The bottom ones, banks, insurance, utilities, whatever. I need somebody to understand from risk management what exposure I want, but I don't know if it's per unit of alpha generation if I need a fundamental person there as much. So we do that every month, because sometimes you'll see bubbling up. That's getting a little bit, that's rising up the ranks a little bit. Maybe I should have, bring my widget over there and spend some time because I can get some alpha there. So that's one whole vector I'm thinking about, one branch of the tree. I'll be shorter on the second point, which is, if I were a stock picker, I'd want to know what the company-specific risk is and how replicable it is. Meaning, if a stock's got a lot of company-specific risk and I can't find other stocks to trade like it, then it would be worth my time to have conviction that's either long or short, big from the index. Because then if I'm a good stock picker and I have enough of those over time, I should really be able to add value. I might love Brunswick Corporation because they make outboard motors and they're gaining share from Yamaha, whatever the pitch is. But if I go back to my desk and I realize 15% borrowing costs and a $50,000 motor, kind of pretty macro stock, because it's almost like a housing, and then I can find 70 other stocks to trade like it, not a great use of my time, because I can replicate it from the risk management perspective, and it's kind of macro. So I want to know the company-specific risk and replicability if I'm a stock picker. The second branch, sorry, of the logic that you asked me, short question, long answer, which is probably a bad cocktail, but is, where can fundamental people really add value? Where do quants fail? And if I know where quants fail, maybe I know that's a place that I should spend my time. And I'll give you some examples. New management team, CEO or CFO is new, has a new plan for margin expansion, shareholder return. Then I need a person's judgment about whether that is an effective strategy, whether it makes sense, whether their pricing stack, whatever it is. So quants they don't know if there's a new CEO. I remember years ago, I was at a big stock picking event as an aside, and this guy pitched the stock, and his pitch was the greatest pitch I've ever heard. This is the 4th time I've tracked this management team. I shorted the previous 3 to 0. And everyone was already asking what the borrow cost was. Okay, so if you have the history of the management team and that's not something guys can download that quickly. I think the other things you want to do as a fundamental analyst are ask yourself, is there something that's complex, the capital structure, a tracking stock, some of the parts valuation? If that's the case, then every lawyer and banker has already pitched the management team on breaking that up. Did they do a deal that was more than 20% of their market cap, where your ability to create a pro forma P&L on, is going to be additive versus a quant model that's looking at backward stuff that's no longer relevant. Those kind of things. Litigation, is there some, of course, stocks look cheap when there's an off balance sheet, kind of fear that's massive. Right. So all those kind of things, there's a 25, 30% of the stocks that has something like that going on. That's another way to answer your question. That's where a fundamental guy should sink in, because they're going to be able to add value that something systematic can't.
How should we think about factor alphas evolving over time, right? If I went back to, 1992 and read Fama French, I'd want to buy small stocks with high price to book with good momentum, right? And many of these factors just have stopped working or reversed in some ways over time. As you think about building factor models and harvesting factor alpha, how do you think about, secular versus cyclical alpha pools for factors? Or said differently, if I'm a stock picker in 2024 and I'm looking for individual stocks, what are the factor overlays that I should think about as good factors versus bad factors? Are there, in your mind, things to avoid, things to harvest, or is everything just hedgeable down to this idiosyncratic alpha?
Look, I'll start. The first thing that popped in my head is like, look, quant's totally different than it used to be. Okay. When I started in the business, people were looking at 12-month horizon. They were looking at signal decay being, over several months. They were saying, I'd like my portfolio to be kind of cheap on price to cash flow, or have positive momentum and upward revisions, those kind of things, right? Well, the world's changed. As you said, the market gets increasingly anticipatory. Upward revisions haven't worked. In fact, they've been perverse for much of the last, decade plus. And I think part of the reason, the first thing that popped in my head was, look, most quant money run purely quantitatively today is 3 hours to 2 day holding period, mid-frequency. I think 10 days is kind of getting to be kind of long. Right. So the idea that you're going to show up and say, I have a, 50% annual turnover, my book, I'm going to hold stuff for 2 years, and I want to buy stuff that, cheap on cash flow with upward revisions and good momentum, and I'm going to hold, like, that hasn't worked for a long time. Or it's a lot more complex than just dividing the top 3,000 universe into quintiles. And I think part of it is because so much money, think about it, a 10-day strategy, which I think is definitely longer than most quants, that's still turning over, 10% of your book every day, right? So there's got to be a signal that's coming, every minute or something to price liquidity and something else. So I think the factor stuff has moved a lot. It will continue to move, and you have to always be mindful of that. One approach that we've tried to use to get in front of that is to look at the volatility in the efficacy of a signal, not just whether it works or not. And what some academic research will show, if a signal gets more volatile in its efficacy, you should de-emphasize it going forward. So if I buy stocks that are cheap and short those that are expensive, and that generates high return this week, and then like lose a lot next week, and it's high the week after, I probably should just not use that valuation metric until it starts to stabilize in its efficacy. So there's some ways you could try to factor time generally, which I think is an embedded kind of in your question. The other thing is that just some things just change. Like I'll take something as simple as, forget factors, take something as simple as the relationship between Fed fund futures and multiples. If I asked you in 2021 through 2022, you would say, well, as Fed fund futures go higher, the 12-month and 24-month fund, people think rates are going to be higher. Growth stocks are going to get creamed because EV to GP or EV to forecasted sales or price forward earnings, whatever valuation you're looking at, it just got slaughtered. You saw that with biotech and software. And I mean, people forget NVIDIA was down 65% in 2022, right? So a lot of that was the relationship between the perception about future rates and multiples was incredibly negatively and statistically significantly correlated. Then you go to the end of 22 and into 2023, and people said, well, kind of closer to the end of the hiking cycle than the beginning. And all of a sudden, perception about rates staying where it was or going higher was positively and statistically significantly correlated to multiples. So I think it's worth tracking in some sort of rolling window the efficacy and the volatility of the efficacy, because that can kind of help you understand whether you should be de-emphasizing, at least in a shorter window, a signal or not. I have one other thing that popped in my head on that question, and then I'll pause and have you course correct me. But I don't think fundamental analysts do a good job of thinking about whether the signals that they're thinking about, they don't use the word signal, the variables they're using are correlated. So let me give you an example. I walk in, I'm a new analyst, Richard's my boss, and I say, hey, Richard, Here's why I like this stock, right? I think they're going to beat earnings. There's going to be upward revisions. I think they're cheap on price to cash flow. I think the gross margins are expanding, and I think they're buying back stock. All right, well, that sounds like a pretty good pitch, right? And you might have some field research on why the margins are expanding and all that stuff. But what you don't ever say to yourself is, what Richard never says back to me as the new analyst is, wait a minute, well, how correlated are the signal gross margins and price to cash flow and revisions? And there's sometimes any quant who builds a model to predict return is going to try to have signals in there that it's hard to build orthogonal signals, but at least they're not totally correlated to each other. So that if one works well and another one fails, the whole system still does okay. One of the things that we track is the correlation between common signals in each industry in the market. You can sometimes see where all of a sudden, all the signals that used to have an average correlation to each other of maybe 0.1 or 0.2, all of a sudden are 0.6 or 0.7. And that's telling you that maybe something's changing about how people are perceiving it. And it's not quite captured by the company-specific risk algorithm I mentioned earlier. It's something else. So maybe it could be, okay, after COVID, look at November 9th, 2020. I think that was the Pfizer vaccine announcement day. All of a sudden, like anything in REITs that was considered reopening, it didn't matter if it was expensive, had high CapEx. It just, all of a sudden, the signals got super correlated. So I think, that's another thing to think through is like, how correlated are the common signals to each other in each industry?
Adam, you talked about the sort of analyzing factor space and using factor signals to sort of identify where to focus fundamentally. And then in contrast, there's the idea of just isolating into idiosyncratic bets. How do you think about where you should devote your time? Is it to maximize your idiosyncratic alpha opportunity, or is it to use that factor space to identify broader themes that aren't being caught in that space? How do you think about the relationship
Yeah,
between those two?
that's a good question. I think it's actually kind of both. Right. I mean, in other words, I think most people, depending on what multi-strat they work at, they get pretty familiar with the risk parameters. They might say, oh, I thought the beta was 1.4 and then the stock beat. And then they told me it was, 1.7 and I generated different alpha than I thought. And I might be angry about that. And if you tell them, well, but it might have happened on the short side too, and you would have lost money, that they have an asymmetric view. Most of these guys are so smart. They're trying to figure out how to trick the algorithm, how they get paid. And that could be, for example, I actually want to buy tech companies that have high stock-based comp to revenue when tech's outperforming, and I actually want to short them when tech's underperforming. So that I can make some non-neutral ways, and there's lots of factors like that people pick up on, and guys who are used to trading 20 or 30 stocks, they kind of pick up nuances, and a lot of times quant factors are looking at bigger baskets of stocks than the fundamental analysts focus on, and so they might get a little nuances. They might say, oh, well, I know the optical ones trade different than semi-cap equipment, trade different than analog semis, and different than AI GPU semis, and I can use those kind of arbitrageable things, and the risk algo guys don't really do that because they're looking at thousands of stocks that are trading with higher frequency. So I think that's the second part of your question, is sort of tricking the system, and I think everyone naturally tries to do that to maximize their own comp versus the system. But I think the bigger issue is really what you first asked about, the first part of that question, which is, can I strategically differentiate from the index by spending my time in areas where the returns aren't easy to replicate and where it's more of the returns are company specific? I think the answer is yes. I think people should be spending more time on those names. And they might say, okay, here's Starbucks or whatever. I'm not saying they should be long. I'm saying they should have the biggest positions possible, long or short. Because if I can't replicate the returns, and a lot of the returns are idiosyncratic, then a smart person who's really good stock picker over time should want to have the biggest positions possible in those kind of names, and then let the other side of the book, whatever it is, get them the factor exposure that offsets it the way the risk algorithm allows them. So, but it depends on the firm. As like there's 2 or 3 religions when it comes to risk management, and it depends which school you came, if you came from the New York school or the Chicago school or whatever school you came from, right?
On that last point, you mentioned like the Starbucks example or whatever the specific name is, but where you sort of are kind of specifically sourcing for higher and idiovol, or at least a projected idiovol number or residual volatility. And I guess what you're looking for is sort of something that has a tendency to continue to have higher idiovol, a propensity to, or something about in that kind of zip code. So, and then solve the factor problem in whatever other way you kind of you kind of can. So I guess, yeah, how is that kind of the first signal for where to spend your time is just idiovol? Is that the first order kind of analysis? I'm sure there, as you point out, so much
I mean,
analysis.
I would say if you give me two things, I would take, some combination of level and change of the company specific risk, or what you call idiovol. And the second thing would be how many stocks I think trade just like it. And if there are none that trade like it, that replicability thing I mentioned, correlation, how many stocks over the last year have 0.7 or higher correlated? Sure, it could be spurious. I could have, Intel going up because they got some privatization bid while crypto is going up from some minor bid because China did a stimulus. You can get spurious correlations for sure, especially in a shorter window. But if I look out and say, okay, holistically, how many stocks are kind of trading 0.7 or higher correlated over a year? I want to have very little replicability and high idiosyncratic risk as a place to start my fundamental research.
And you want low correlation, which is sort of the same as that high idio, actually.
They're not mathematically identical, and often you can get differences. But yeah, let me give you an example of that just to hammer it home. You can't find me a lot of stocks that trade just like Microsoft. Okay, it's hard to find a basket. If I could, I'd take the 3 trillion market cap. If I was long only and I was trying to beat the S&P and I could find 30 stocks that traded just 0.7 or higher quarter to Microsoft, I probably wouldn't own any Microsoft. I just take 3.3% positions in the 30s name, mirror its performance, and be done with it. Why take, right? Because it's got pretty low idiosyncratic risk, and why take that on? But the fact of the matter is, I can't find anything that replicates it. So what I tell long only people is Microsoft should probably be covered by their chief risk officer, because at the end of the day, it's like really low idio, and I can't replicate it. So I would just try to hold close to the market weight, not let it hurt me or help me, and go to areas that are high idio that I can't replicate. I'm not saying somebody should cover to know what their technologies are, what deals they're doing, but I'm saying the size, whether they own 4, 5, 3, 6%, has to be done by a risk guy in context of all the other exposures they have.
Adam, you've worked with many of the leading investment firms in the world as clients. You've spent some time at investment firms as well. Are there any core principles that you've learned through those experiences in terms of blending the fundamental and quantitative? So the leading, most compelling quantamental strategies that you've seen, what do those look like, and what are the foundational principles there?
I'll give you a few of them. I'm not sure they're prioritized from best to worst, but I'd say one is things change. So we talked about how signals change. So if you're just saying, I'm going to own deep value stuff come hell or high water, I'm just going to lose you money when value doesn't work. I guess some allocators will stick with you, but I think being intellectually flexible and reacting to changes in the data, some Bayesian approach has to be the better way to do it, or it makes more sense. I guess if you're already a billionaire, you can do whatever you want. But I think if you're not yet, you probably want to be sort of humble that things change, and you can learn, and you can learn from anybody, and I worked at a firm where the culture was amazing, and the CIO, the most junior person in the room could say something and disagree with them, and he'd be like, maybe. It was. So I think being receptive to the fact that you could be wrong, or your heuristic is no longer applicable, is probably the number one thing I'd say. So that whole human notion of, if you're not worried you're wrong, then somebody, you're a psycho, that whole thing. So I think that's one. I think two is on the short side. There are two things that I think over time work, which is, high accruals and bad momentum. So if you tell me you want to short a stock at highs, I think you're fishing in a really disadvantaged set of waters, very bad waters. Most people short stocks down meaningfully for highs make more money when they short them at highs, because they're battling both fundamental and price momentum when they do it. I'm honest and I say, well, I've always liked stocks at higher prices that I used to not like them at. Stock goes up and I like it more. On the short side, you should like something more as a short when it's already down from its highs than you do at the highs. And that's hard for people because they want to romanticize their contrarian. Two is accruals. Accruals work well, meaning when there's big disconnects between earnings and free cash flow, whether it's from PP&E, CapEx, or from inventory, from intangible or whatever, there's some reasons it can happen. But if I plotted you, kind of share a loss, margin contraction, and I put those against accruals plus bad quarterly momentum versus the industry average, I don't think you can beat it. So you can spend all the fundamental time you want telling me they're going to lose share and their momentum and their margins are going lower, and that will not underperform. That will not be a better short idea than they have high accruals with bad momentum. So I think on the short side, it's a little bit of a different flavor than the long side. I would also say if you shorted something and lost money on it, and then you go back to short it again just because it's a higher price, I probably would caution you against doing that also, because I think a lot of times valuation-based shorts. Actually, I'll say it on both sides. Leading with valuation is no bueno. Okay, you got to have something else besides it's cheap or it's expensive. I would think the market is different now than it was 25 years ago, and buying something just because it's cheap, I think the market's right on average to take multiples lower because those businesses get most impaired during an economic recession, and they're cheap for a reason. And that reason is they suck when the economy slows. So I think the valuation part's a little less compelling, on both sides of the book. I think on the long side, it's hard to gather assets and tell people you buy crappy companies. So most people say I buy quality companies. So the rubber sort of meets the road about what do they mean by that? How are they quantitatively downloading some technological mode or some sustained high level of margin but if you said, what do we test empirically? What do I have confidence in? We looked at everything from upward revisions to share gain versus your peers on the top line to capital deployment, etc. I think the two things that matter the most are gross margin expansion. So companies that have high, improving gross margins over time tend to disproportionately get rewarded on EV to forecasted sales or EV to gross profit. So they get the double whammy of higher margins plus higher multiples on those higher margins. So I would be looking and spending a lot of my time as a fundamental analyst on, do I have a differentiated view on gross margins versus consensus? Do I think they can expand? I'll spend one more layer on that, Brett. I think it could be from either the pricing and mix side. So I would say the last year, a very topical issue has been dynamic pricing. Who has pricing? Who has sustained pricing even if the economy slows? That whole kind of post-COVID conversation. And then it could be on the cost side. And do I have productivity to offset wage inflation, or is wage inflation moderating? What about logistics and commodities and other input costs, currencies? What about depreciation? And is there a way that I can have a differentiated view on gross margins? And it's interesting because a lot of what I did in the past is I did regression between change in sales and change in gross profit. Boom, right? Year over year, scatter plot. Slope of that line is the incremental margin. So what is the margin I'm going to get on revenue above today's level, the incremental margin? Some sectors call that drop through, right? So I think a classic framework, quant framework would be, okay, I'm going to long stocks where the incremental margin expectations embedded in the consensus outlook are at or below the business model average historically. And I'll short stocks that are way above, believing that that's a proxy for estimate achievability. I think the layer that's sort of different now, and we all get a little bit shuddery when we say it's different this time, but because of AI or other productivity or predictive analytics, can companies grow the revenue without a lot of net hiring? And therefore that historical fixed variable cost algorithm for incremental margin no longer applies. And I think a fundamental guy can add value there too, right? Because they can tell me, hey, wait a minute, this business probably is not going to do net hiring, or their incremental margins can make sense. As the cycle gets farther and farther from the bottom, it's harder for me to believe that companies can get their incremental margins way above the business model average. Like unless they moved all their employees to, I don't know, Laos or whatever a lowest cost area is, or unless they have a huge roll off into depreciation, or they got a big pricing increase or something. I need the fundamental person to tell me that, and then they can evaluate whether my sort of highest expectations for incremental margin versus business model. Maybe some of those stocks, yeah, Adam, that makes sense. They did a deal, they moved their employees, they depreciate. Okay, great. But I want to start with estimate achievability on gross margins as like a major sort of tried and tested, proxy on the long side. And I think the second long thing would be, so that's margins. The second thing would be, how are these guys are they good stewards of capital? So what are they doing buybacks versus ASRs? What are they doing on dividend growth? What are they doing on deals, lever up, lever down, those kind of things. So I guess summarizing what I said, long side gross margins and how they're deploying the capital, short side accruals and momentum.
And Adam, what role is there? You kind of talked about heuristics and how different macro aspects play through, or factor types of aspects play through the single stock fundamentals and what they mean for price strategy. How much of that involves sort of, maybe for lack of a better term, like now casting the implications of the macro environment that are happening right now? And what's the role of like just a macro view into that kind of view, your view of the world, basically?
So we ingest a few hundred macro variables. Some are daily signals, some are weekly, some are monthly. And we try our best to create almost like sine waves in about a dozen categories. For example, what's happening with the US consumer? So we'll look at things like the master trust data for 90-day credit card delinquencies, or retail sales, or Michigan confidence, or the auto sales, or how those kind of things, right? We have one for industrial activity, so it'll be everything from miles driven and van dry rate per mile and bulk shipping and car loads and truckloads, to PMIs and factory utilizations and rig counts and those kind of things. So we try to create some gauges for where we are. Some of those signals are monthly that I just mentioned you, and then others like currencies or commodities are daily, minute to minute, right? And so I don't do any now casting. I think it'd be hard for me to compete with Walmart or Google, where they're getting, or Amazon, where there's, I guess these guys are doing a couple $1 billion of revenue a day. So I don't know, almost 700 billion in revenue. So they're going to get some real time now casting that is kind of hard for Trivariate to compete with. But I think the way I think about it actually is a little bit more for gross exposure recommendation than net. Implied in your question was like, can I get a directional bet on an equity market or on risk taking? Here's what I do, and this is you gotta, like, if we've been nerdy so far, I'm gonna crank one more level of nerdiness up the way I answer this question. So I have these quantitative models that predict subsequent stock return. So I try to forecast forward return. So I sort all the stocks from 1 to 3,000, and I say if I long 1 to 600 and short 24 on through 3,000, can I generate some excess return? Yes, the answer is yes. We do it through a combination of the stock level forecasts, okay? And so what I found is that in some macro regimes, some of my models, some parts of my modeling work better than others. So let's say if I told you that when financial conditions, which is one of my 12 areas I look at, when financial conditions are easing, my ability to pick good banks from bad banks is really bad. But when financial conditions are tightening, my bank's model works awesome. So if I can react to where I am in financial conditions and say, okay, I've got enough evidence now that things are tightening, I might choose to gross up or make bigger positions than normal, or have more bank stocks get to the top and bottom quintile, because I know my bank's model is more likely to work well in a certain macro regime. So I'm able to, I think, even more than a kind of a net call or making an industry long or short call, I'm able to tell you whether my ability to pick winners from losers is better in certain macro regimes than others. Now, it may be that some of the huge multi-strats don't care about that because the analysts are fundamental stock pickers, and all that I mentioned is handled by the risk guys in the back room. And we do talk to a lot of risk guys. We have a whole risk arm of our business, and I spend a lot of time at chief risk officer dinners and nerding out on 0-day options and picking off Delta One desks between 2 and 4 p.m. There's a lot of risk stuff goes on. But I'd say for your fundamental analyst crowd, they might want to think about whether, what a lot of fundamental guys are doing, or what quant guys are doing. Like, take banks as an example. You're trying to buy companies that are attractively valued on, price to tangible book, and they have net interest margin expansion potential, and they're doing a lot of shareholder return, whether CCAR allows them to do it, and their statutory surplus ratio looks pretty good, or their comp ratio is coming down, whatever the signals are they're looking at. Well, quant guys might be using those signals to predict subsequent return, weighting them in different ways, saying I'll long the ones that look attractive and short the ones that look unattractive, and I'll try to generate return that way. And maybe they generate 6, 8, 10% unlevered return per annum in their bank's model. Okay, great. Well, what if the bank's model generates 0 return when financial conditions are easy, because the crappy banks go up more than the good banks, and it generates 20% return when financial conditions are tightening? I can maybe use the macro indicators that go into the financial conditions say, you know what, now is the time for us to really, the banks model works great. When financial conditions are tightening. Okay, so I see they're tightening now. They've tightened. We have some algorithms, 15 the last 20 days or whatever. Okay, we're going to make the call, and then we're going to basically put an amplifier on all the bank stocks that moves more to the top and bottom of the overall ranking. When you do stuff like that, though, Richard, what you have to be careful about is that you have to admit that you're going to be late implementing the strategy by the macro, and you're going to ride it over the edge. And it still has to add net value, meaning it's not a nowcast. I'm reacting to, hey, financial conditions are tightening, and I'm going to put a strategy on, okay, increase gross exposure of the banks. And I'm going to, even though I'm going to be late doing it because I didn't, get the financial conditions tightening perfectly, and I won't know until they start loosening some that I should sort of de-emphasize the gross exposure I put in. It has to add value. So I think about it almost like candy cane shape, right? Like if you imagine a sine wave, I'm going to be late and I'm going to ride it over the edge, and it's still point to point. It has to add value by grossing it up that way. And so we measure that really carefully to see, are we kind of good at, and so we try not to put, I don't want to call a smart guy today who's a big client of mine, say, oh, you should gross up your bank's model today, and I call him tomorrow just because 10 spreads moved and degross. That destroys value. So it has to be a slow enough moving signal that they can kind of capitalize on it. So I kind of don't do the nowcasting. I do the what exactly is happening right now. Let me assume it's going to continue. And if it does, can I pick winners and losers pretty well? And I try to turn on, we have like 21 models that we break the 3,000 stocks into, and then maybe 2 or 3 that I'm confident in any moment are going to work better than others. And I'll try to kind of increase my gross exposure to those groups. So if I were talking to a pure fundamental guy who doesn't care about what the risk guys are doing, I might say, you know what, some of the traditional factors tend to work pretty well right now. And so that might be an opportunity for you to just, leg into stuff that is classic at distinguishing winners from losers in this cohort.
I think the question is, when you're thinking about factors, how much sensitivity is there to the macro? I think a lot of factor research kind of ignores the macro regime, but it seems like part of what you've observed over time is that certain factor signals work well in certain macro regimes.
That's definitely true. I mean, yes, that is definitely true. I'm not sure how much of them are spurious or aren't, because the problem is, if you're not doing like a high frequency macro regime like I'm not, in the last 20 years, I might have 5 complete consumer cycles. Okay, so I might need 1,000 years of data to really be confident. But I'm pretty sure that we can show all right, the top versus bottom quintile spread of our banks model, as an example, is incredibly strong, 20% per year performance when financial conditions are tightening, and it's 0 when they're loosening. So there may be some times where I can kind of confidently come in and say, you know what, this is a regime where I can do well. And it's going to be correlated to, risk on. Financial conditions are basically, is it risk on or risk off, right? In a way, right? It's a combination of, credit spreads and, a bunch of stuff in there. So I think in industrial activity, our ability to pick winners from losers improves when industrial activity is flat or slowing. Consumer activity. So I think there are, and I would say, look, I don't really want to be spurious about it. So it has to make logical sense. I can't come to some guy like you with all your experience and be like, oh, when financial getting tightening, my ability to pick healthcare or whatever, it has to be something that it's common sense. When the consumer's slowing, that should matter a little bit to picking winners from losers in consumer discretionary. That makes sense to me. So I worry a little bit. One of my favorite books, it's a website too, is this guy Tyler Vigen, Vigen, and he has a spurious correlation website. And it's really amazing. I'll do it real time here just so that people can do it themselves and laugh. But if you go to this guy's website, he will show you some charts. It's a book, and it'll have charts that really look amazing. And it'll be such air pollution in Albuquerque versus Google searches for who is Prince William. And this thing looks perfectly correlated with 2 lines, right? And so I think part of embedded in your question is can you get spurious correlations that are nonsensical? Of course you can. And so you want to overlay that human judgment on top of it, for sure.
What do you make of, the rise of smart beta and more factor-based ETFs? I mean, it seems like many of these firms have harvested the academic research of historical correlations to raise ETFs, active funds that overlay these factor baskets. Now, perhaps your point of spurious correlation, the cyclicality of these factors, I might sense some skepticism, but what's your kind of take on this whole industry?
I'm willing to pay for true alpha generation, and I think that it can be had. But to pay fees for pretty common factor exposures, it would be tough to sell to me. But that might be like asking an eye surgeon if they want, contact lenses from somebody else or something. I don't know. Like it's just not spend too much of my life thinking about that kind of stuff to pay fees to some ETF that has 40 bips fees and probably needs 100 million to break even, plus pay somebody, and like it's just all a marketing ploy. It's not reality.
Yeah.
There are more ETFs than there are stocks, so you should start off by being skeptical.
Right. How do you think about the when we had Ricky Sandler join, one of his points I thought was really interesting, I keep contemplating, is he made an argument that the market is over themed, that the market is too thematic and has become increasingly thematic in the last few years and decades. How do you think about the impact of themes and narratives in your stock selection frameworks?
So, well, you mentioned Ricky. I should point out to your viewers and listeners that I worked for Ricky directly, sat in the office next to him. I've known him for 25 years, have pitched in on some quant calls for his students that he teaches class. So I know him incredibly well. And I think I mean, this is not like a feeling. I analyzed every trade he made over an 18-year period, and he's a great stock picker, and he's very good at sizing. So that's not like a feeling I have. That's actually my job, was to help him get more analytically rigorous around risk management. So, I learned a lot from him. And I'd say some of the things I mentioned you earlier are kind of our DNA that came from him, actually, which were, being intellectually flexible and not being dogmatic, and kind of changing your mind as data points come in that are new, and being intellectually honest with yourself about where you have an edge and where you don't, and, having high conviction when you see something. I mean, he's really an expert in a couple of things, which is financial accounting and knowing what businesses should earn, what their actual, when you run your own business for 25 years, you get smarter about who has pricing power over you and who doesn't. And obviously he's been on boards of companies and seen it through a lot of angles. So, I think as an example, look, he's a bottom stock picker, and he's always going to think about whether things are undervalued or overvalued, where he gets the numbers in 2 or 3, 4 years. So and he's great at that. I think in terms of the themes, though, it really depends. Like, I don't think he thinks about it that way, because he doesn't find it effective to gather assets by telling LPs that he invests in themes. And he's made, a lot of money for his LPs by thinking that way. I think if you're like the head of a giant private wealth network with thousands of advisors, then you do need the themes, Brett, right? You need to say, all right, well, there's some things that I think are going to grow above GDP for the next 3 to 5 years. And, it's AI semiconductors, it's AI software, it's electrification industrials, it's housing, it's life sciences and healthcare services due to aging demographics and more productivity, or whatever, right? And there's things I don't want exposure to. I mean, if you live in New York, this will resonate, but you don't want to ever walk into the front end of a CVS or a Walgreens, or, Target, or any physical retailer, or, commercial real estate, or whatever. And so I could see somebody looking back 5 years from now, if you're a long only portfolio manager at a big firm, and one of your clients, you run into Brett on the weekend at soccer. Hey, well, I've been reading about this AI. Do you own any exposure to AI? And the fund manager says, nah, I don't own any of that. I couldn't make the valuation work. Then you're just a jerk, right? So I think you have to think about the themes depending on how you raise the money, and sort of what your LPs expect from you. If you're in a private wealth network with a bunch of advisors, you have to think about themes, because they resonate with the crowd, and they need to tell the people who gave them money that yes, they have exposure to those themes. But if you're a pure bottom-up stock picker with a 1-year window on what your LPs expect, I think you've got to be less thematic, and it makes sense that Ricky said that. So I know, like, if I'm talking to a group of 200 advisors at a big firm, I'm going to mention those themes. I have a slide: things that grow above GDP, it's AI semi, like it's that list, and things that grow, and I'm going to say on average for the basket of stocks I own, I want to be over indexed toward the themes I think are growing GDP plus, and under indexed toward those that I think are not. But within that, I'm sure someone who's as good of a stock picker as Ricky and others would be like, well, I'm long stuff in your bad themes, and I'm short stuff in your good. Of course, that's true.
You made another point about sizing. And I've heard this debate all through my career. It's a fundamental investors have sizing skill, or they don't have sizing skill. At many of the large firm multi-manager firms, there's skepticism about the sizing skill at fundamental investors. What do you think in terms of principles about sizing that you've observed to be principles that have driven good sizing decisions versus bad sizing decisions?
Well, I think sizing is definitely correlated to liquidity. And so most managers would say, I know the price it trades at and how many days or minutes it takes me to barf my position. So I would say in practice, liquidity definitely matters. And so that's where maybe the academic research falls down. I have a couple of examples of empirical work that a combination of quant and fundamental work when it comes to sizing. So you kind of like kicked off the conversation with the word quantamental. You know, I'll give you this a little bit of a long story, but I think you'll appreciate the landing area. Which is, so when I got to Morgan Stanley, I launched as a U.S. equity strategist at Morgan Stanley the first trading day of 2011. So I started there in the fall of 2010, and I thought to myself, I wonder if the analysts here at Morgan Stanley generate any alpha. I wonder if their overweight positions that they recommend actually beat the equal and underweights. And it turned out at that time there was maybe 7 or 8 years of data stored, a few thousand stocks and stock buy recommendations, and it was about 50% overweight and 50% equal and underweight. So I just decided, let's just say you liked it or you didn't. I beta adjusted it because analysts actually recommend higher beta names. And when the market goes up, they think they're good stock pickers, but much of that is assumed by the bounciness of their recommendations. And then I also didn't count any rating changes till 24 hours after they made it, because sometimes the stock blows up in the aftermarket and then the analyst downgrades it before the open next day. And I didn't think it was prudent to give them credit for that. So when he did that, over the 7 or 8 year period I evaluated, the analysts generated, I think it was 4% alpha per recommendation. And then had a classic quant model in those days. Again, it's 14 years later now, but 14 years ago, top quintile beat the bottom quintile about something like 8 or 9% per annum. But what was interesting is if the analysts recommending stocks, if you bought only the ones that the quant model also liked, and you avoid the ones that the quant model didn't like, you got like 13%. So there are just 3 bars in the chart, kind of fundamental only, quant only, and fundamental plus quant combined. And there was a lot of evidence that when both agreed, you got better subsequent performance than when they disagreed. So, and it was a large sample. These guys didn't know who I was. There was no, so I felt like there was some. When I got to the buy side, we were able to implement some strategies where we have some clients now where the way their fund works is, let's say you're the CIO, you submit the trading. I want a 200 bips position in XYZ. I don't tell you, but if the quant model likes it, they make it 250. If the quant model doesn't like it, they make it 150. It doesn't disenfranchise you as the fundamental analyst. It's still in the book. If the quant model is neutral, you get your 200, whatever. And on the short side, because a couple of the firms are hedge funds, we made it more like 25 bips instead of 50. I guess if you were market neutral, you can make it the same size, liquidity dependent. But the idea would be if you get some unemotional governor where quant model agrees or disagrees, you could use that for sizing and gain some edge. Sorry, one other thought on that, Brett, is just I'm not sure that I wouldn't also consider what I said earlier, which is, is it highly company specific risk and is it replicable? Because if you work for me and I believe that over the next 5 years you're going to be a good stock picker, then I probably will make stuff bigger if it's highly company specific risk and not very replicable. And sure, it'll suck if you're wrong, but if you're right 55, 60% of the time, and I give you enough at-bats, I'll be glad I did that.
Are there any, in that quantamental approach, are there any common situations or pitfalls where fundamental investors look for stocks quant models don't like? Are there any characteristics that we as fundamental stock pickers consistently make that maybe our blind spots are picked up by the quant model that we don't see fundamentally?
When we tag stocks quantitatively, we have a lot of clients that send us their portfolios through custom risk work. And a lot of times they say, well, we're quality guys and we buy, it's a quality growth fund or whatever, let's say. When we tag stocks unemotionally, we sometimes find that a lot less of their stocks are in the highest quality quartile than they think. And a lot of times when somebody like that will say back, well, no, that's future high quality. And it's like, okay, well, I'm just describing the microstructure that if we get a risk off trade right now, this stuff that's not the highest is gonna act the worst. So sometimes it's about They're kind of on an emotional tag for quality. Sometimes they think it's more idiosyncratic than it is. Um, sometimes they are longing stuff with bad momentum and high accruals, which I told you is the key to shorting stuff. Sometimes they long stuff with the margins rolling over and they want to change the book and talk about gross profit dollar growth instead of gross margin level. Or, you can't re-educate the buy side on how something trades. I can sit around a high horse all I want and tell you should look at GAAP earnings versus pro forma earnings, but if the market doesn't look at it that way, you can get carried out over 20 years until they look at it the way you do. So, I think you have to just understand how it trades and recognize it's going to be different in different industries and sectors.
You have any recommendations for the early career stock picker who's listening to this quant, knowledge, listening to this macro knowledge? Like, what is the recipe to get smarter in these areas? Is there anything that you read daily, weekly, monthly, any books or any other processes that could help all of us to?
Yeah. I mean, I love this stuff, so I spend most of my waking hours doing this, but I would say learn what you can. And I mean, this is very self-serving, but I would say like not all of the best ideas only come from the biggest 4 or 5 firms. There's plenty of random boutique guys like me that are doing interesting things. And, I mean, I used to be a number 1 ranked semi analyst, and I worked at a really good fund, and I worked at Morgan Stanley, and now I have my own firm. The idea that I'm dumber now than I used to be doesn't make any sense. So, pay Trivariate Research for the content is one example of what I would say. I mean, and there's a lot of other guys like me. So I'm not, but I'm willing to learn from anybody, and I'm willing to learn from, I read MIT Technology Review as an example. I like things where like, I don't think there's a political element to what's happening. And, I think one of the things we all struggle with is holding accuracy and bias in the news and all those kind of things. And so find things that are scientific or factual or empirically studied and go after them. So, I read quant journals. We do a monthly professor series where we interview these guys on interesting topics. We do a lot of natural language processing of transcripts to look for trends and see if the stocks are actually changing their behavior. So a lot of it is like really analyzing what's going on in the corporate results. To name a publication, I'd say MIT Technology Review, I find pretty interesting. But I don't do any TikTok or, as Bill Belichick says, snap face. I don't do any of that.
How profound or not do you think AI will change your approach in the process of quant investors, fundamental investors in the market in the coming years?
I think it will a lot. It really depends on the industry, and it certainly depends on the industries they're analyzing too. When I was at Morgan Stanley, we had 9 guys in my New York office and 4 in India, and I think we produce more content now with 3 people than we did with those 13. I bought an NVIDIA chip. It's on an EQIX. I can search every earnings call transcript and every SEC filing back to 2011 for every company and look for a few words, let's say dynamic pricing, and then see if those companies that are mentioning it, and let's say it's only the earnings calls and it's only from the Q&A, not from the management team, whatever. I can see it had their multiples change, have their forecasted margins and change, have their forecasted earnings change, and they have more revisions of performance. I can do that in 2 hours. 10 years ago, it would be like somewhere between a month and never. Right. So like the efficiency is massive. And I think, whether you call that predictive analytics, quant, data science, or AI, in some cases, those are just all synonyms. We're doing a couple of generative projects right now, but they're hard. We're doing one on semiconductor inventory for like a year. It's hard. But in terms of the companies themselves and the businesses, we do a lot, and we're trying to figure out like how much margin expansion potential is possible, and looking at high, it's called low net income per employee or low revenue per employee with high employee count companies, and trying to find areas where I could dream they could be more productive or they could grow their revenue without any net hiring, whether it's in healthcare services, hospitals, distribution, whether it's in telcos, like, whatever. There's a lot of businesses like that. In terms of the finance industry itself, I think there's a lot of opportunity, right? I mean, I think that's why I said to you before, like, if you're not worried you're a fraud, you're probably a psycho. Like, you should be worried about what skills you have and how sustainable they are. And, I told you, like, I I have a PhD in statistics. I was a #1 ranked analyst. I worked at Morgan Stanley. I had the most read product, the #1 equity business in the world, and I'm constantly worried I'm irrelevant and nobody's going to care. And when I sometimes say to people, they think I'm lying. I'm like, no, I'm worried about being obsolete. Like, I just took a course on AI for healthcare at MIT, and it was like mind blowing about all these possible things. And I was thinking, thank God I took this, and like I'm just scratching the surface on my awareness of what's going on. So I think the AI stuff's going to be massive. I think you want to pay attention to which companies are doing things that aren't just saying they make AI. Like there was that AI toothbrush thing, a year ago. But do they are they buying GPUs? Do they have LLMs? Like what data do they have? What moat do they have? Can they analyze the data, use predictive analytics to improve? Like, yeah. Can they predict their customer employee behavior? So I think it's going to be a huge theme for the next 10 years on corporate profitability, for sure. And it's probably going to bear out a lot of new industries, whether it's in legal or in kind of human, kind of data, quality control for the models and those kind of things. So I think it's somewhere between bullish and wildly bullish on its implications in the medium to long term. It's always tough, October, are you going to get something incremental that makes you think the return on investment is merited? Who knows? But of course, these things are going to be higher in 2, 3, 5 years.
Well, thank you, Adam, for all your time today. That was incredibly insightful and educational. Yeah, for those of you listening to this session who would like to learn more, Trivariate Research online or email me directly at brad@FundamentalEdge, and I'm happy to make an introduction. Thanks so much for your time, Adam.
Yeah, great questions. Great to meet you, and look forward to talking again.